the volume and revenue growth performance across the board has been a bit subdued. There have been a few factors that have led to this. The first one is the fact that over the quarter you have seen a slowdown in growth. So while October and November months were a little better for FMCG companies, December growths have been slow. The same has been pointed out by Nielsen in their survey as well. So that has impacted the growth overall. I think the second impact has been on the channel fluctuations in terms of general trade, modern trade, and e-commerce. So that has also been a factor that has led to certain disruptions in volume growth, for FMCG companies this quarter. I think the third thing has been the fact that there has been a delayed winter, which has impacted, growth for at least for the skincare, product companies. So at an aggregate level, revenue growth has been a bit disappointing across the board. However, the margin performance for FMCG companies largely across the board has been encouraging, led by the fact that commodity costs haven't moved up. In fact, they've been fairly benign, and companies have continued to enjoy gross margin improvement, which is partly compensated for the impact of volume growth. The third thing that we've seen this time around has been that, for the first time in 3 or 4 quarters, companies have started to spend less in terms of advertising spend. So advertising spend as a percentage of sales has also come down in an environment where companies feel that demand is subdued and beyond a point pushing spends is not return accretive. So those have been the 3 key trends. If I look at the situation going forward, I don't expect a material pickup in quarter 4 as well. I believe that there will be a continued subdued impact on growth, while it might be a tad better than quarter 3 because certain channel fluctuations have been sorted out for some of the companies. But in aggregate level, I believe that quarter 4 performance will mirror to be slightly better in terms of revenue growth in quarter 3, but not a material uptick.
If you are at the liberty of taking names of companies, where are you placing your bets, or which companies do you expect to do better as compared to some others in terms of growth going forward? If you can't take these names, can you at least describe the kind of companies that you're talking about?
Yeah, I think in our initiation note in September, we had put out our top picks. Our top 2 picks were Dabur and HUL, given the fact that of the diversification in the portfolio, the strong presence across price points, and the strong push on distribution. We believe these were companies that would continue to do well, and probably outperform peers. Over the last 2 quarters, this thesis has fairly well played out. Our picks do not change from our initiation time, and we believe that companies at an aggregate level that are large, diversified, have several portfolio levers to bank on are probably going to do better as compared to companies who are single product or have a large skew to one product portfolio, and also companies where the crude dependence is higher could see a benefit on margin as well.
Can you also talk us through how you're reading the gross margins picture? I know that raw material and input costs environment has been relatively benign, which is why a lot of these companies are taking advantage, possibly to a certain extent, also passing on these costs to keep and help volumes. But what's the way forward? At some point in time, I'm sure the base catches up.
You're already seeing that, you're right. Apart from crude oil, the balanced commodities have seen some kind of an inflation. So if you look at palm oil, the PFAD prices, which are important for soap manufacturers, has seen a very sharp increase over the last few months. While in the very near term, there has been a bit of a fall again, but at an aggregate level, there has been an increase. Similar for food prices, whether it's milk, sugar, wheat, etc., you have seen increases. So I think while you have seen a very benign pricing environment for in revenue growth for FMCG companies over the last 1 year, you will start to see price increases starting to flow through into the numbers from as early as end of quarter 4, and that could possibly kind of boost the revenue growth a little bit and will be used also as a margin management tool. I still think that companies will be fairly conservative in passing on pricing. They won't pass on pricing over and above what they need to, given that the volume environment is fairly subdued. But yes, you will start to see companies pushing through prices. So even if you look at for the last few quarters, the volume and value growths have not been very different for FMCG companies. That should start to change a little bit as companies start to kind of pass on pricing growth. I do believe margin maintenance will not be a challenge even going forward. I think the key factor is how volume growth moves up on two parts. One is on how demand kind of moves up specifically in rural, and secondly how consumers absorb these price increases which are coming after a long time in FMCG.